We're live. I kind of promised you guys and girls that y'all come on in and give everybody a little time to come in that want to catch it live. If you don't catch it live, you catch a full playback. If you get this, so you don't want to hear me talk, catch the playback. And the people are going to catch it on YouTube as well. But I recently had a poll that said, who wanted, 1 second here. I'm getting so many messages right now. Give me 1 second. But y'all come on in. We're going to do Walmart versus Target stock if you want to catch it live. Walmart versus Target stock. I recently did a poll. I had a poll right here on YouTube channel that said, I did a poll here on the YouTube channel. Okay. Yeah, so I recently did a poll on YouTube channel that asked everybody which two companies they wanted me to go after, or which two company stocks they wanted me to compare. And everybody, not everybody, but a couple people commented. And the one that I liked was the Walmart versus Target. So I went down and I did an evaluation. And I noticed that I kind of like reading the reports of two different companies. But we're going to jump straight into it today. We're going to talk about what we compared, what we read, real life facts. So, once again, ladies and gentlemen, boys and girls and children of all ages, you're now tuned in to the Investor Show. As always, I'm your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. Drop some comments below if you got comments. And also, don't forget to hit that bell icon if you're catching this on YouTube and all of the great stuff. But as always, I don't have a lot of time. I definitely know you guys and girls don't have a lot of time. So we're going to jump straight into it. Walmart stock versus Target stock. These are the two biggest brands out there, the retail, grocery store brands or whatnot. So what I decided to do was I took about, it probably took me a couple of hours to sit down, pull up both of the annual reports and do research on Walmart and Target. So what I decided to do was I looked at the market capitalization for both. We're going to look at the dividends for both. We're going to look at the total revenue, the total assets, the total liabilities, the network, the PE ratio, kind of stock price. We're going to look at the total debt. We're looking at the brand, and we're also looking at how much cash is on hand. All right. So hopefully that makes sense to you guys and girls. That's what we're going to go down through, because some people sit back and when they look at the evaluated stock, the first thing they always look at is they look at, oh yeah, I know that brand. I like that brand, but they don't pull back the finances. For prime example, if your friend came to you and said, hey man, can I borrow $10? I'll pay you back next week. And say if you really needed your $10. The first thing you're going to do is you're going to do a mental evaluation of your friend's financial situation or if they can pay you back. If you work at a good job, a white collar job, somebody asks you to cover them for lunch and they'll pay you back, you won't care about it because, hey, we make pretty good money, right? Because you did a fair assessment of the finances of that particular person. So when I look at put my money in places and to invest, as I became a more seasoned investor, I started to realize you need to start ripping out the finances. Stop going off of the name. Stop going off of the he said, she said, oh, I heard this company is going to do this. Look at the finances. That's exactly what we're going to do. So first thing first, let's look at the market capitalization. The market capitalization is pretty much how much is the company is worth. It is calculated by taking the shares outstanding times the stock price. So I like to look at, I like to take that from Warren Buffett. One of the things he said is that he doesn't look at when he goes to evaluate the company, when he look at the buy stock of the company, he looks to evaluate the entire company. Like, what if I'm buying this whole company, right? So first thing first, Walmart market capitalization is $338 billion. That's a lot. $338 billion is the market capitalization, current market capitalization of Walmart. Target was $56 billion. So Walmart had way more market capitalization than Target. Now, the reason why I look at market capitalization, because I like to look at market capitalization, look at the stock price, look at the revenue, it kind of gives me an image of if the company is overvalued, how much is the company overvalued by? So I like to look at how much is the company worth altogether. So market capitalization, Walmart is a way bigger company. Now the next thing I'm looking at is do they have the revenue to justify the market capitalization? For prime example, the market capitalization, if I could think about top of my head, I think Uber is like 50 something billion or some crazy number, and they're not even profitable. How does that make sense? How can you justify? How much money do you make? So, just same thing. If you went to go get a loan from a bank, first thing they want to do is they want to know your ability to be able to pay them back that loan. So that's how it really works. You know, income. Next thing, dividends. Dividends. Target currently pays a dividend of 2.39, and Walmart pays a dividend of 1.78. So that means that Target has a higher dividend than Walmart. So Walmart dividend is slightly lower, but it's not so far off that it's not worth comparing. So the dividends are kind of on the same playing field. One is 7.8, one is 2.39. A big signal I like to look at dividends. I like to invest in companies, obviously, that are going to grow in the future to make money, but I also like them to pay me a dividend along the way. So if they pay a nice little dividend, that's a plus size. But I don't like high dividends. The reason why I don't like high dividends, companies that usually pay a high dividend don't move that much, right? So, like a company like Verizon that pays 4 or 5% dividends, companies like that don't skyrocket in the short term, right? Versus when you look at a Google, when you compare Google to a Amazon, I know there's two different ends of the spectrum, but uh, Verizon pays a nice dividend versus Google pays no dividend. But 9 times out of 10, Google is probably going to grow way faster than the Verizon stock price wise. So anyway, so nice little dividend that almost on an even playing field. When we look at the total revenue for 2018, I'm looking at 2018 because obviously I'm not looking at 2019 because we're still in 2019. So 2018 total revenue, we're talking about 72 million for Target, but we're talking about 500 million for Walmart. So the revenue is five. Walmart has a 5 times higher revenue than Target. So the revenue is way higher. Another thing I noticed about Target revenue is Target's revenue was slowly declining, but it was up for 2018 and 2019. But it had a slight little decline versus Walmart revenue was growing. So that's the total revenue, how much money these companies are bringing in. Now, so Walmart obviously won that battle, with 500 million in 2018 versus it's pretty much 5 times, almost 6 times more revenue than a Target. Now, the next thing I like to look at is total assets and total liabilities. Total assets for Target was 40 million versus total assets for Walmart 2019 was 204,522 million in their total assets. So Walmart has way more assets. Doesn't mean a lot, but I like to compare it to your liabilities. So the liabilities for Target was 28 million versus the liabilities for Walmart was 126. So while you guys and girls, if you're watching live, hit the thumbs up button, share it, all of the great stuff if you like the content. Now that I know the total assets and liabilities, guess what I can figure? If I know the total assets and liabilities, now I can figure. Uh, Jared just commented, got a lot of comment that says Walmart's not going anywhere. Now that I know the total assets and liability, what can you figure once you have a total assets and total liabilities? Total assets, total liability is you can figure out the network. I like to look at a network. If I was comparing households, the company with the higher network is usually more stable, and they usually have a way of going into the future. So the network for 2018 for a Walmart was 77 million versus Target was 11 million. So that was another thing that I looked at as well. Guys and girls, give me 1 second. I'll be right back. Give me 1 second. Somebody was ringing my doorbell. That's why I'm back. So anyway, network for Walmart is 7 times higher when I look at the network for Walmart, right? So we know the total assets, total liabilities in the network. Walmart wins that. They have more assets, they have more liabilities, but when I look at the actual network, it's better. PE ratio, Walmart PE ratio was a little bit higher, but I really didn't care about that because I'm looking at the real stock value, right? PE ratio is a good indication of price to earnings, and it kind of tell you if a company is overvalued. Walmart was at 25.9 versus Target was at 18. Not a drastic change, but it does say Walmart slightly overvalued. But I don't really care. I won't say I don't care about P ratio, but I'll actually look at the numbers. If I got the actual real numbers, I'm not really following P ratio. I can figure it out on my own. Now we look at stock price. Target stock price is 109. Walmart stock price is 119. So the stock prices are not that far off. They're almost in the same part. So if I had $125, I actually can afford to buy either one. They're not, one is $125 and another one is $10. So the price is kind of, they're only about $10 off currently, right? Now another thing I like to look at is debt, right? So Walmart total debt was 11 million in 2018 on their books versus Walmart was 42 million. So Walmart carried 400 times more, 4 times as much as more debt than Target did. But when I looked at the debt, I compared the debt to the revenue because who cares if I only make $10,000 a year and I make $10,000 a year, but I have $5,000 worth of debt. That's a problem, right? Versus if I make $100,000 a year and I have $10,000 of debt, it's not that big of a problem. So I just didn't look at the bare numbers. I broke down a percentage. When I broke down a percentage, I got 15% because I compared it to the revenue, and I got 8.4% for Walmart. So Walmart debt problem is way higher to their income versus Walmart. When I did a debt to income type ratio. So Walmart, even though it carried more debt, it had way more revenue, like we said, obviously. No, I will get to that, Jared. Jared asked the question. So, do you think Walmart is undervalued based on earnings? We'll get to that in a second. Now we look at brands. Now I look at brand power, and the most powerful brand I believe in the space is Walmart. I believe Walmart has a way bigger brand, but I also believe Target has a better brand. So, for a prime example, if you have a Target near your house, you're probably living in a good neighborhood, right? Versus a Walmart, it's a hit or miss. That's one way I can judge a neighborhood. Just go to the nearest Walmart. If that Walmart is ghetto, dirty, or whatever, it's a strong possibility that that neighborhood probably is as well. So Walmart is like a McDonald's. You can get whatever you can, a McDonald's could be a hit or miss. I've been to some clean McDonald's that I wanted to sit down and eat at. I've been in some McDonald's that I just kept on driving. So it's a hit or miss. It's like a McDonald's and Chick-fil-A. A Chick-fil-A, you never see a Chick-fil-A in the hood, right? All Chick-fil-A's are clean. They're all pretty much the same. Versus a McDonald's, it could be a hit or miss, right? McDonald's, you can, you don't know. But I can judge a neighborhood by that. Jared laughing about it, but I'm a man. Been in the military 16 years. I traveled a lot of places. I've been a lot of places, and I lived. Let's say I permanently lived in Connecticut. I lived in Connecticut. I lived in California. I lived in Florida. I lived in Hawaii. Now I live in Colorado, and that's not even counting the places that I lived in Japan for a little while. I was over in Europe for a little while. I don't even. Places I've been pretty much everywhere in the United States is worth going. New York to LA, not worth going, but the big cities, New York, LA, Vegas, Chicago. So I'm pretty well traveled. And by being pretty well traveled, I've been to a lot of places and I've seen a lot of things. And most times, if you got a Target near your house, that means you're in a good neighborhood and you never hear nobody with a dirty Target. The shopping carts are clean. The floors are always mopped. The customers are nice. The things are always hung up. So Target has a better brand. So when you push that cart in Target, it actually works. The wheel don't stop working. A string is not caught up in it or whatever. The Target is always warm in the winter, cool in the summer. Always a good brand. Nice, clean compared to a Walmart. A Walmart, I've been to some Walmarts. I'm like, wow, that's nice. And I've been to some Walmarts where it'll go down, if you know what I mean. So he said I had two. He said I had two Chick-fil-A's in my neighborhood. So you say you got two Chick-fil-A's in your neighborhood and a nice Target. I already know. Somebody by the name of Jay Mommy. I don't even know where you live, but I know it's a nice area. I know you live in a affluent. That's a fancy word, everybody. An affluent neighborhood, right? I'm gonna give you some more brands. I might be holding an episode on it. If you got a Target, you got a Chick-fil-A, if you got a Whole Foods, if you got a Sprouts, those are four brands that come on top of my head. They're always what you call it. Another one, somebody just said it. What's going on, Miss Rich Butter? I'm gonna give you another one. A Popeyes. I got a Popeyes near my house, right? And you can judge a neighborhood by how the Popeyes look. If the Popeyes if the Popeyes look hood, that neighborhood is probably hood. I don't even have to know where you live at. You just take me. I go to a neighborhood. That's how I judge places. As I move, I travel. I go to a place. I go to the nearest Walmart and I observe. And I can tell if it's high class, low class, medium class, all from the Walmart. If I got a Target near, I know I'm in a good neighborhood. If it's a Chick-fil-A down the street, good neighborhood. Either it's a good neighborhood or it's a very populated shopping center. Because let's think about it, guys. Franchises do studies. They do studies. They know where their restaurants are going to do well. They look at income levels. They look at traffic levels. All of the good stuff. Pay attention to the CEO of Red Robins came onto the show, and what did she tell you? She said, "Hey, we put the Red Robins by high traffic areas, so they always wherever you see a mall, there's probably going to be a Chili's or a Chick-fil-A. You know." Somebody said, "I think it's economical racism on the low." Yes, it's more about people talk about black and white. It's more about green and white more than black and white. Back in the day, they said, "Hey, we don't want your kind here." Now they say you can't afford to be here. That's just how it is. But I don't want to get off the topic. I know some people kind of so we look at the total debt. The total debt, Walmart is doing a way better job of handling their debt. The debt is way lower. So the reason why I pay attention to debt, because debt is very easy to get when the economy is booming, right? So now, next thing I want to look at is cash. How much cash do you have on hand, right? How much money do you have? Because if the economy take a downturn, and it becomes hard to pay your debt, this gives the survivability. Who's in a better financial state, right? Just like somebody who has a bunch of cash money laying in their checking account versus somebody who has little money laying in their checking account. And come on, guys, hit guys and girls, hit the thumbs up button and hit the share button if you're coming in and you like what's going down. But when I did that, I compared the cash to the ratio, the cash to revenue. That's no cash to debt. I looked at how much cash they have versus the debt, right? And what I came up with is that Walmart has a more cash on hand than Target, because it's a bigger company, obviously, but they're also doing a better job at managing their debt. So I look at, since both of the companies is 119 and one is 109, and I also compare stock performance. I want to mention that too. Stock performance. Target versus the S&P 500. Target has outperformed, and Walmart both of them have outperformed the S&P 500 over the 10-year. This 10 years is good because the market has been booming over the last 10 years. So since the market has been booming over the last 10 years, strong market, and if a stock has been able to outperform the market when it's booming, that's a nice indication. Because if the stock is not outperforming the S&P 500, I might as well get the S&P 500. So both of them are doing that. But when I compare Walmart to Target together, Target is a way better performer. Target's performing way better, right? When you compare both of the stocks. So when I look at both, and I look at Target and Walmart, if I was to go and invest money today, I think the company that has the best value financially is going to be Walmart. The company that has the most growth potential is Target because Walmart is pretty mature, right? So I do like Walmart, and I do like Walmart more than I like Target. Target has a better growth potential, but Walmart not so much, right? The other thing is when you look at when we look at a Walmart future growth of a Walmart, it's a little bit more mature, so I can see it being a little bit stagnant, a better value company. I think it can withstand a Amazon coming along or somebody else versus a Target, right? So I do like the Walmart stock overall better than the Target. Now, somebody asked me earlier that said, "Do I think Walmart is undervalued according to its earnings?" No, because I forgot the formula that I use, but I use, I think it was total assets versus total liabilities divided by outstanding stock prices. And I want to say it was like Walmart was at like $40 or something, right? So, and Walmart's trading for 119. But right now in the bullish economy, when do everybody want to buy stocks? Everybody want to buy stocks when the stock market is doing well. So you have a lot of overvalued companies. And when you pay attention to a lot of big legendary investors, they're not buying much. You don't see uh, Berkshire Hathaway buying up a whole bunch of stuff. But I guarantee you, when the next economical downturn, they're going to be out there buying up some of everybody. So right now, the market is considered a little bit overvalued, a little bit overpriced. So when you look at the book value of Walmart and you look at the stock price, is overpriced right now, right? So it's definitely not undervalued according to its stock price, and so neither is Target. Target is, but when I evaluated, Target was more overvalued according to its stock price versus a Walmart, because for what I just told you guys, Walmart has um, five times more revenue. Network is way stronger. Books are way better, but Target and Walmart stock prices are right there. But you also got to remember stock prices are betted on in the future. People are betting on the future of Walmart. People are betting on the future of Target. So Target has a brighter future than a Walmart because Walmarts are everywhere. They kill everything. They're the kings right now. But it's just like who has more growth potential in the next 10 years? Me or my son, who's 8 years old. Wesley is probably going to grow more than me. Now he could stop growing. He could be a little midget, but he has more growth potential than I do. Just like a Ford and a Tesla. Tesla has way more growth potential than a Ford, and I think that's the kind of situation or why Walmart is trading even higher because people are looking at the future. It had a great year this year, stock performance wise. So people looking at the future target, they may see something there. But financially, if I was to buy one share today for long term and I was a little bit more moderate, I would go to Walmart. If I was a little bit more aggressive, I want to be a little bit more riskier, I may choose a Target, right? But both of the companies, when I look at a recession proof, both of them are pretty much practically recession proof. They're in the grocery lane. It's something I see athletes, guys with millions of dollars. I think it's the dumbest thing in the world that they do. They, I know several $1 million athletes, and they'll go in and be like, "Oh, I'm trying to jump into this new tech company," and I'm like, "Idiot! Why not just go buy like 5 grocery stores in a small town?" My hometown, where I'm from, Waynesboro, Georgia, has 2 grocery stores. 2 grocery stores. I think it's probably like 5, 6,000 people in the city limits, but it's 2 grocery stores. You have enough money to where you can take $1 million and go buy both of those grocery stores, and those people are going to go there. No, it's 3 grocery stores. Come think about it, it's 3 of them. You can buy all 3 of them for probably about $2 million, right? And that's recession proof because people are going to eat regardless of the economy. If I lost all my income today or tomorrow, I'm going to eat. I'm going to drink water. I'm going to eat. I'm going to find something to eat. No matter what's happening in the world, right? So I don't know. That's just me, but it's a conservative investment. That's my Target versus Walmart. I think that Walmart financially on the books is obvious to see that Walmart is better suited for an investment versus a Target, but Target has more growth potential. All right, so Walmart's been making smart investments lately. Their stock is, in my eyes, They're still undervalued, and they're always crushed the holiday season. Of course, they're gonna kill this holiday season. I don't know now. Amazon's coming along. I don't know. Like, look at Denver, man. We're pretty much snowed in today. And if I was shopping, I would not be walking to Walmart. I don't go to Walmart.com. But you know what? I like Walmart.com because they have Wesley Learns book series on Walmart. Thank you, Walmart. I think Target does too. So, but that's my evaluation of both stocks, Walmart versus Target stock. Somebody said, how about the eyes of a dividend investor? Would Walmart be better? Yes. Yeah, Amazon. I don't know, Miss Butterworth. She's saying something real, you know. And Barnes and Noble. Oh yeah, Amazon. Yeah, Amazon is holding me down. Barnes and Noble is holding me. Appreciate Barnes and Noble. What was his name? Jay Fox came out to Barnes and Noble when I was in New York. I did a story time and a story time and book reading and signing and whatnot in Barnes and Noble, New York City, the largest Barnes and Noble, Union Station. So shout out to Barnes and Noble and Jay Fox, who came out and saw me or whatnot. I'm wearing his hat because I ain't got a haircut. But so shout out to Barnes and Noble, shout out to Amazon, everybody that's out there that's supporting me and support the podcast, all the great stuff. So somebody said the dividend investor. The dividend investor, yes. One thing, what is the biggest thing about dividends? Dividends are not what? Dividends are not guaranteed. Just because they're paying dividends today, they don't mean they have to pay dividends in the future. That's something they bet on, not they vote on every quarter of what dividends they're going to pay. So when I look at dividends, I like to look at the history of dividends. But the thing about dividends is Walmart is 1.78 currently. That's the dividend yield. Please watch my video on dividends versus dividend yields because as the stock price change, so does the dividend yield. So currently, the dividend yield for Walmart is 1.78. Target is 2.39. So if I was an investor, the dividends is not that crazy. It's not that far off to where I'm like, well, I got to go with Target. Now, it'd be different if Walmart had, let's say if I was comparing I'm trying to think of two companies in the same industry where one pays dividend, one doesn't. Let's take the two I can think of off the top of my head is, let's take a Google who doesn't pay a dividend because I do own Google. And let's take a Microsoft, do own Microsoft, right? But they're not in the same industry. And so Google pays 0. Microsoft, I want to say, pays like 2 to 3% or something like that. Then that may kind of sway me a little bit. Then I may, let's say if I only got $500. I'm not even buying Google. Google costs more than $500, right? So stock price pays a point as well. But if I was a dividend investor and I had money to buy both, I would, if one company wasn't paying and one company was paying, I'll be more leaning towards the company that is paying. But since Walmart and Target are both paying dividends, it's just that one is just a smidge higher. I can't see it. Appreciate it, Jerry. Jerry said great information as always. So, but yeah, I think it was Jay Fox that came out and saw me at Barnes & Noble. It was nice to meet him. He asked me not to post pictures of him, so I didn't. But it was nice to meet somebody from who's been watching me on this YouTube and podcast to actually come out and see them in person and all of the great stuff. But yeah, so that's what we did. For the people that's catching this live or the people that catch the playback, somebody was ringing my doorbell, so I had to go check that real quick. But we looked at market capitalization. We looked at the dividend. We compared it to total revenue. We looked at all the assets. We looked at the liabilities, the network, stock performance versus the S&P 500, the PE ratio, the total debt of both brands, and we spoke about the cash. Hi, Prince. Do you see Fitbit jump up 30% yesterday? If the rumors of Google is going looking to buy them. Yeah, I did see that yesterday, because like I just said, Google is a stock that I own. So that's what always happens when two companies merge and somebody buys out. The big company stays the same and the little company jumps. For prime example, let's say if it comes out that Bill Gates is, not even Bill Gates, let's say Microsoft was going to buy Snapchat, right? Snapchat stock would jump, Microsoft would stay the same. Happens all the time. It's on the rumors because people like to say, "Oh, well, what does he know about this guy?" And the same thing that happens in humanity. Same thing I've seen happen with myself personally. Right? People saw me. Well, they see me with different people, and it just raises my value for whatever reason because they think, this person knows something that they don't know. It just raises the value. That's just how it's going to happen. So yes, when you're the big boy on the block, that's what you got to do. You got to eat the little ones. Like Facebook brought Instagram, Facebook brought WhatsApp. When you're the big boy on the block, Google has been buying a lot of companies. It's just that Fitbit is a bigger name. So that just is what it is. But I thank y'all for tuning in. Thank y'all for checking me out. I just did a video. I'm going to be uploading this soon called I don't even want to talk about it. I'll let y'all see it. It makes no sense to talk about it in another video, tell you about another video. Still a fan of Berkshire, or what? What do you? I'm not getting what you're saying there, Gerald. Gerald, I'm not getting what you're saying. Berkshire. Thank you so much for everything. Oh, Berkshire, yeah, of course. Of course, I'm a fan of Berkshire. Berkshire's lately, let's think about it this way. Somebody's asked me if I'm a fan of Berkshire investments of late. Berkshire has been very slow with the investments lately. The last big investment I saw they made was like $1 billion in Amazon. I want to say they brought like $1 billion with Amazon. I think before that they brought like a couple billion of Apple. The last big acquisition they made is Flying J's. But you got to look at it. Berkshire, look at the books. Berkshire has $125 billion in cash. Can you imagine $125 billion sitting in cash? So, yes. So, why are they slow? Why they're not investing? It's just if you know Warren Buffett and you know his style of investing, he's not going to buy anything. He's going to be very slow to buy anything right now. Right now, and probably on his desk in his office, he probably got a bunch of notepads where he's probably going through 10Ks and he's trying. It's harder to find something. It's harder to find a diamond in the rough when everybody's doing well. Once you have a cat, like think about it. Let's have a real conversation. We already talked about Target versus what you call it. Big news this year: Tesla finally became profitable. Tesla finally became profitable after being in business for 16 years, right? So that means from 2003 to 2019, Tesla was making, no money. But at the same time, they were buying a bunch of stuff. So a financial guy like a Buffett, he's not going to buy that company, right? He's going to wait to a company like a McDonald's, right? Very profitable company that has a lot of real estate, or Walmart. He's going to sit back. He's going to wait until that company goes on sale. That's his MO. That's Berkshire's MO. They wait till a company goes on sale, and that's when they go in and buy them all the time. So Tesla, I'll get to you in a second, Kendrick. I saw your comment. Thank you for holding me down. Kendrick been holding me down. A lot of these names I'm saying been holding me down for a while. So that means from 2003, they didn't go public until 2010. Here they are in 2019. They've finally become profitable. Now, how does a business stay in business for 16 years not being profitable? Uber, not profitable. Lyft, not profitable. These companies are burning through billions of dollars a month to stay alive. It said that Uber is losing $1 per ride, right? But they're still in business. So when somebody like a Berkshire, they look at stuff like that, they're not going to invest. Their first rule before they buy anything, you must be profitable. So if a company must be profitable, most startups are not profitable. So if you're not profitable, you're not even on Berkshire's list, right? So it's that, okay, well, this company is profitable. Then if they're going to go buy the company, it's like what they always say. They want to buy a great business for a wonderful price, right? They want to buy a wonderful business for a great price. They're looking to find good companies that are on sale. That's their MO. So when the economy is booming like it is, you're not going to see too many acquisitions. But look back in 2008, what did you see Berkshire big moves on? Bank of America. JP Morgan, all these companies they doubled down on. So right now they're slow right now. You don't see Berkshire, and we've heard Buffett say it plenty of times. He's looking to make a big acquisition. He's looking to buy stuff, but he's going to look for something that's on sale. Yes, does he have enough money? He can go buy Uber. He can go buy Lyft. He can go buy this or that or whatnot. But that's just not the MO. So he said, "Did you see sales decrease? Must be lying." I haven't peeled back the layers of the onions of Tesla. Tesla shot up, dipped 10% just a month ago. Do you think Johnson & Johnson is currently on sale? You know what? I got to look into Johnson & Johnson. I heard them a lot. I know they've been in the media. They just had a big lawsuit. So you know what? I'm looking at Johnson & Johnson. I'm glad that you brought that one up. Let me write that down. J&J. I remember Johnson & Johnson. Thank you. I be flexing. I be flexing. That's your name. That's funny. Kendrick, but do you remember Buffett tried to buy a stake in Uber? The CEO turned down. I don't remember that. I had to look into that. But you got to think about it, right? Kendrick, too, you got to think about it. The stake in Ubers and things like that. Was he trying to get in privately or publicly? Was a company a publicly traded company or was it a privately traded company? And Jared said, buy low, sell high. Yes, I'll be flexing, considering all the lawsuits. And yeah, that's true. They do have a lot of situations. Because, yes, if it's a difference, because you got to think about it. Kendrick, when a company goes public, there's a public stock price, right? Exactly. When a company is private, it's a different price. Like when it's private, they may say, hey, we'll let you get in for $5, right? But when a company goes public, it may go public at $50. So the public price and the private price are two different prices, right? So when he was trying to buy privately, what price was he trying to buy privately, right? Versus when it goes to the public market, now it's going for $70. On the private market, you're probably looking to buy a whole bunch at $10, right? You don't know. So when it's private, that's why it's private. When you have a private offering, it's a private offering, right? So, and that's my dream one day. I want to take a company. He said probably 25 cents. So yes, so the price that somebody gets privately is totally different from what we get to the public. So that's how people become millionaires. When you look at every wealthy person, they're taking some company public. So they're like, oh, okay, let me get 1 million shares for $10, right? By the time they get through filing and they go public, now the company goes public, it's $70. They've already made a 700% return on the investment just when the company went public. So totally different levels to it. Ms. Bird, Prince, would you mind giving me 3 of your top picks for children investment, medium risk, for me to look into? All right. Somebody just DM me this on Instagram too. Right now, children investments, this is how I would set up, this is how I set up my son's portfolio. If it's a child is 1, 2, 3, they're under 10 years old, you're looking at holding it over 10, 15 years, right? I look at your the portfolio has to be full of stocks, right? So baseline, I look at it like 3 layers of cake. The baseline level I like to look at S&P 500. Probably more than about 50% of your portfolio should be something like a Charles Schwab index, SWPPX. And the reason why I say SWPPX because it's cheap, $45, $46 right now. And compared to if you did the exact same thing with a Vanguard, it's like 200. The SPY is 300. So $45 is actually reasonable for an everyday person. It pays a dividend. 2, 3, 95% of investors will not beat the thing over the long period of time. So you can't beat the market, you join the market. So now you automatically have the top 500 companies in America. Number 2, the second thing that I would look at, the second layer of the cake, I like big blue chip companies. Big blue chip companies, Google. We use Google every single day. I use Google. I like Google for myself. Another company that's doing very well for me is McDonald's. Kids love McDonald's. It's something they relate to, right? I like McDonald's. I like Google. I like Microsoft. And in that second layer of the cake, I like to look at, and literally it is cake. So when we look at the second layer of the cake, I like to look at companies that have a high growth potential, usually technology companies that are good financially, right? Apple, every kid loves Apple. Every kid loves Microsoft. So my portfolio would be S&P 500 A bulk of my money would be going to the S&P 500 every week, every month, whatever. If you're getting child support, spousal support, whatever, start investing some of that money, right? So it would be S&P 500 at the bottom. Second level, I'm looking at a Microsoft. I'm looking at Apple. Those companies pay dividends and they have a high growth potential for the future. I like Microsoft. I like an Apple. I like a McDonald's. I may look into a Starbucks, but those are three off the top of my head that I like for that second layer of the cake. The top layer of the cake, this is when you may want to get into, you want to put a little seasoning. You may want to put a little icing on it. This is where you look into the things like a Uber, things like things that are right now, they have a high growth potential for the future if they figure it all out. I just feel Uber has that vibe of a Facebook. I just do. I figure, it came out, Facebook, I remember when it came out for like $40, $50. I was like, what is this? A social media app? That's crazy. It sunk down to $20 and, it wasn't profitable. It didn't look too good, but they figured it out. And, now they are what they are now, almost $200 per share. I think Uber has that poise. That's just me. They're burning through billions of dollars. I mean, what type of crap is that? If somebody threw billions of dollars at me for a decade, of course, I'm going to figure something out. You don't have to be a rocket scientist, right? If you got that many people throwing, that's like if my dad told me to go to the garage and he's just going to throw me millions of dollars until I figure something out, I'm eventually going to figure something out. So I think, so at the top layer of the cake, this what gives the portfolio a little fun, or whatnot, because when you just sit back and buy the index and you just watch it, it becomes boring. The second layer makes it a little bit more interesting because you have things like a Walmart. You have things like a Walmart. You have things like a Target. You have things like a McDonald's, things that the child is using every day, that you're using every day, an Apple, a Microsoft. You go to work every day and work on a Microsoft computer, but you don't even look at the company. Microsoft has had an amazing year, one of my top performing stocks of the year. Another sleeper, Bank of America. Bank of America has done extremely well this year. So, and at my top level, I would look at something I may consider something like in that Uber. It's a couple other technology companies that I know that are out that I may put a little season, a little spice on it for it to grow. And that would be my 3-layer portfolio for a child. He said, I don't think you're wrong either on Uber. They are disrupting the transportation industry fast. Miss Butterworth said, hey, I have homework to do. Yes. Start off with the things, Miss Butterworth. Look at things that you're using. Another smart investment. When you look at Berkshire Hathaway's, one of the top 2 investments is American Express, MasterCard. Debt, right? They invested into people, consumer debt hugely, right? So start with what you're using every day. You're using a Visa card, you're using a MasterCard. The child loves to, come Christmas time, you're going to buy him an iPad, an iPhone, or whatever. He loves to sit on his MacBook Pro. He or she loves to play on their Microsoft computer. Or whatever. Start looking into those things that you use first. You going to Walmart every day. Like some people are tuning in right now. They've been going to Walmart and Target for the last 20 years and have never thought about purchasing a share of the company. So hopefully start with those things first. Oh yeah, Nike. Thanks a million. Yeah, somebody said, what about Nike? Yes, I brought a child Nike. I have a book club, the Wesley Learns Book Club. For people who don't know out there, I have 3 books, children's books. Wesley Learns to Invest, Wesley Learns about credit, Wesley Learns about insurance, their financial literacy books. And what that does is what I did, I did a book club, and the girl that won it, I brought her 2 shares of Nike. So I do like Nike going into the future. It was something that the kids relate to. Nike has a very strong brand. It has a very strong place in the market. Even though you see all these shoe companies coming out, I don't see Nike falling off anytime soon. It pays a little dividend, and that's why I like it for a child. I like Nike as well. Ms. Butterworth said, I'm about to give my son, 11 years old, $500 and get him into the stock market with Wesley books. He's very interested in that. Oh, wow. That's awesome. For him to start buying pieces of companies or whatnot and evaluating companies. I have this weird, I love to sit down with a notepad probably play a podcast in the background, read investment books. If you can see my library over there, you will see I have a lot of library books. And I love to evaluate companies. Weird, very weird. And right now, as we're speaking, I'm pretty sure, and J.P. Morgan, Chase, Berkshire Hathaway, all these companies, they're doing the exact same thing. Right. So that's very cool. I wish that I was introduced into the world of financing and investing when I was a child. Um, which I was kind of taught about. My dad did a great job. I love my dad. Rest in peace to my mom. They were great parents. I had great parents growing up, and they're a lot of my success. But I wish that I would have had some. I wish I'd have had an uncle like me that would have sat down and opened up me a brokerage account, gave me $500, let me buy stocks, and continue let me play with the stock market. So who knows what had I, I'm 35 today. Had I probably would have started when I was 8, 9, 10, 12 years old, when I was outside probably eating dirt. But what I probably would have became by now. But it's okay. Everything happens for a reason. I'm learning and I'm becoming that person now. And I always tell people I'm becoming the greatest investor in the world. So I don't think there's nobody, it's some people out there that I see that are not that good. But anyway, I'm learning. So yeah, same here. My dad had stocks for me, but I didn't learn about it myself until I was in my 30s. Yes, I didn't start. I was in my 20. When I got into the world of investing, I was probably about 25 when I became interested in investing, and I had to learn a lot of things the hard way before I started to figure things out. To be honest with you, I'm probably like my last 2, 3 years have probably been my best years of investing, but it came with a lot of red years. I had a lot of red years, but I didn't even know it. I started with penny stocks, and I went from penny stocks. I did options. I did forex. I did this. I did that. Studying, reading, traveling the world, and as I learned things across the globe, then when I got my associate degree, bachelor's degree, MBA, Series 65, still going to school, still learning between the PE ratio and all of the good stuff like that. But so I know as I learn, I become better and I become more seasoned. Talk to more companies, executives, and you learn more. So, but these are things I wish I would have experienced as a child. But I didn't have YouTube. I couldn't log on and follow somebody like myself. But doing it now, changing the world. Become good at something. Become great at something. But that would be my thing that I would look into. If I had a child or a son or a daughter, with my son, I buy him stock. I tell him he don't really care about it. Beef, what's going on, Beef? Beef, what's going on? I didn't, Beef. He started IRA for all of his children. Congratulations to Beef, y'all. He started IRA for all of his children. He's had 7 kids. He got almost a football team. Good gracious. But that's awesome that he did that. He's changing their mindset by starting an IRA for them. IRA is a individual retirement account. He said, he DM'd me on Facebook. He's just like, hey man, on Instagram. He's like, hey, looking to do something for my kids. He started IRA for his kids. That's an individual retirement account for his kids. And he's buying the index. He still got his portfolio looks crazy. I don't know why he got 200, 300 positions, but that's him. He gonna learn his way. He gonna see his way. I've been down that path, but he's gonna see eventually. Like, what, Prince is right. I need to change this up or whatnot. But that's great. He's changing the mindset of the kids. So when his kids, when they have a retirement account, their dad did it for them. Their dad passed down knowledge. Please don't pass down money without knowledge. Pass down the knowledge too. Because if my dad would have gave me $30,000 when I was 18, I could pretty much guarantee it probably won't be here today. I probably would have got me a car for a good price and hung out with some friends, and I probably wouldn't have had anything to show for it. But thanks to my dad for now that I have the knowledge, I have the knowledge with it now. Everything happens for a reason. I haven't done too bad, and I learned change the next generation. But anyway, that's Target versus Walmart. For the people that's catching it now, we evaluated Target, we evaluated Walmart, we put the companies against each other. Also, thanks to I'm Financial for sending me this shirt to wear. But we started with Target. We started with Walmart. We broke down their market capitalization, their dividends, their total revenue, their assets, their liabilities, their network, performance against the S&P 500, the PE ratio, the stock price, the total debt, the brand, and the cash. We laid all of that out. When I'm looking long term, fundamental analysis is good for people who are fundamental. This is fundamental analysis, right? Fundamental analysis is good for long term investors. Technical analysis is good for day traders. Somebody who's just trying to jump in, option trader that's looking for earnings. Uh, I made an episode on that called growing money versus making money. Somebody who's looking to make money, a day trader, there's someone who'll be more interested in the technical analysis versus somebody who is interested in growing money. They're going to be somebody that's going to be looking into the fundamental analysis. Somebody asked me, I forgot, I can't even say your name. What is that? You're one and not, but whatever. I can't say your name, but appreciate it. Thanks for the question. Technical analysis versus what you call it now. ML. I'm from Brazil. Brazil is in the house. Can y'all believe that? Brazil. What's going on, Brazil? I'm out here in Denver, Colorado. It's cold. I'm snowed in. So that's how we evaluate the company. Y'all drop some comments on the company y'all want me to evaluate. Two companies against each other. Maybe it's Microsoft, maybe it's Apple. Y'all let me know what y'all want to do. I actually like doing this stuff. And now Walmart is in my crosshairs, but I have to wait till the market takes another downturn. That's bad. This stock market got me bipolar right now. I'm happy that it's at 27,000 and it's growing, but then I'm upset because I want to buy some stuff, but I know it's not the right time to buy some stuff. So I have to wait for Trump. Come on with that tweet, Trump. I know you're going to do it. Put a tweet out. Something happened or whatever. Jobs report. Something comes up. Put some fear in the market. And when that fear comes into the market, since I already done the fundamental analysis, that's when I'm going to go buy. Right? People are like, oh, you're Republican or Democrat? Man, I don't care nothing about none of that crap. I don't care about Republican, Democrat. I'm all about who's going to forward my interests. That's what politicians should be about. My name is Lori. How you doing, Lori? Just finished a finance degree. I'm excited to start working this knowledge. Okay, Ms. Lori. Awesome. But yeah, let me know what you guys think. I just if I wasn't fair in my analysis, so we are money exactly money crats. That's what I am. Are you a Democrat? I'm a money crat, man. I don't care about, because at the end of the day, if you're looking at a president for your livelihood, that's just my personal opinion. You're looking at a president for your livelihood, you're looking at the wrong person. You need to have the people that's looking at the president don't even know who their mayor is. Don't even know who the city council is. Don't even know who the district rep is or whatnot. So that's how I look at it. We're about growing our wealth. We don't care about and congratulations on your degree. I don't care about Democrat, Republican, or whatever. As long as someone don't put their hands on me, I'm fine. I look at the finances. And we look at look at the finances. When you got the finance degree, evaluate the finances of a company, right? But anyway, that's the way I look at it. That's the way I'm evaluating the company. This is how when the stock market is doing well, I write down and evaluate my hit list. And so, I want to get that. I want to get that. I want to get that. I wait till fear hits the market. Once fear hits the market, that's when I turn around and buy. That's why when the market goes down 500 points, 600 points in one day, that's when I start looking into, hey, let's look at it. I'm starting to look into, you know what? I already know about Walmart, buy. I already studied Microsoft, buy, right? People, they call it luck. What they say it is preparation meets opportunity. So right now, preparation. I just need the stock market to fall so I can have the opportunity. So 5, 6, 10 years from now, everybody be like, man, you got lucky. No, my preparation met the opportunity of the market, and that's why I'm going to take advantage. All right. And okay, I will start investing in the U.S. It's not the best moment to start, but I'm investing in long term. Yes, it's not the very, very best. Don't try to time the market. Please don't try to time the market. Have your automatic investments, like, buy every week, buy every month. Do that. But when opportunity presents itself, really go in. Right? That's what Berkshire is doing. Berkshire is just waiting for, they're looking for a needle in the haystack, but if the needle in the haystack is not there, they're just lining up their ducks in a row. I'm pretty sure at Berkshire, they got a hit list of, when the economy goes down, when this company gets in trouble, we're going to buy this, and this, and this. So that's why. Aaron, what's going on? Ron, what they call it? Ron, like Keenan Peele. What's going on? What do you think about jumping into Disney? They're about to drop. Please, young, don't get that's hype. Don't get it. I don't. When companies are doing something new, don't look at the press release and say, "Oh, look, this company is about to do." Look at the finances. That's something I haven't done with Disney. So you have your finance degree now. I don't like when people say, "Oh, Walmart is about to build a delivery service." Okay, that's good. What the finances look like, right? If I asked you to borrow, if you knew I was broke and I asked you to borrow $1,000 and you really need this $1,000, and I told you, man, I'm about to get a job, would you loan me that money? Probably not. You're probably like, well, I need to pay my rent, and this guy's talking about he think he's going to get this job. No, you're going to be like, hey, when you get that job and it start to work out for you, then I can let you hold my rent money. So people are, oh, Amazon to launch this, stock goes up. Google is to do this, whatever. Look at the finances. Does it make sense? Finances. When I became more of a seasoned investor, when you want to become a seasoned investor, look at them, look at the numbers, evaluate your evaluate your craft. You got a finance degree right now. So utilize that finance degree. You need to be cracking open 10K reports. Learn how to read those 10K reports. Learn how to read 10Q reports. Those are what the real financial people are doing. The Ray Dalios, the Buffetts, the whoever's, I can't even think of it, Peter Lynch's. When you go to read One Up on Wall Street, when you go to read all these things, they're always, hold on one second. Hey, let me call you right back, all right? So when you're looking at all these things out there, you have a finance degree, utilize that finance degree. You know what the P ratio is, do the debt to income ratio, do the debt to equity ratios, all these other things. That sounds very amateur when you're a finance major and you're talking about what somebody said, a press release. Finance people don't read press releases. You're going to read the 10Ks, 10 kilos. And I'm not bashing anybody. I did the exact same thing. I used to read press releases. Oh, this company's going to do this. They're about to come out with a new phone. They're about to do this. I heard the sales are real good. Read the finances, right? You want to go get a loan from a bank, they're not going to ask you, oh, so tell me about what you're about to do. Tesla, I may start to revisit Tesla. I never liked the Tesla. I hated Tesla in the past because it was non-profitable and it was like $200-$300 a share. I didn't understand why. But now it just become profitable. I may revisit it. But Tesla has a big growth potential. When you look at a General Motors or Ford, Tesla has a way big growth potential than anybody else. You said true. Uber went public in May and then they went horrible. I always do that. Exactly, right? I never buy IPOs. I might have to put that video out again. I might have to put that podcast out again and tell you I don't do IPOs. I don't like IPO. Exactly. There you go, MF. MF, you been tuned into me out there in Brazil? Have you been tuned into the investor show? Because you sound just like me. They said I don't like IPOs. I prefer to wait to annual reports, watch and study. Who? MF, I'm thinking, did you get that from me? I'm not sitting here saying I'm a genius, but that's something I had to learn over time because I used to jump on IPOs. I remember I jumped on Pandora when it hit the market. I jumped on, I forgot how many IPOs. I jumped on it, and then of course when it gas is up, then it goes down, and and then I learned over time. Oh wow, wait till the annual report, wait till the quarterly reports come out. Start reading quarterly reports, then do your research. But anyway, that's good though. They said I don't like IPOs. I prefer to wait to annual reports than watch and study. That's my coin phrase. I always tell people I don't buy IPOs. Right? Oh, it's coming out today. Come on, you buying a whole bunch of gas. The next big IPO is going to be Airbnb. Watch everybody go crazy and bananas over Airbnb and overvaluate the company. Right? So it is what it is. But anyway, Walmart versus Target, that's what we hit on. Had a nice discussion with everybody. Thank you guys and girls for tuning in. I appreciate it. Dow Jones hit 27,000 points, and then the YouTube channel hit 27,000 subscribers. So I thought that was funny when I saw Beef say that, so I had to steal it. 27,000, 27,000. I'm very appreciative. Thank you guys. I appreciate it. Love each and every one of you. Until the next video, podcast, cartoon, or whatever else you see me do crazy around the globe. Peace. Be safe. I'm out. Thank you. Be safe out there. If you're in Denver, be warm. Peace.